Well, good morning, good afternoon, good evening, and hello, everyone, to the 11th iteration of the massive open online course for the Master's Degree in Digital Currencies at the University of Nicosia. This is Andreas Antonopoulos, and I'll be answering your questions from the last week. This is session 5, Bitcoin in Practice Part 2, and we're going to be talking about Lightning Network, SegWit, as well as wallets, commands, and general questions from the previous sessions. So first of all, let me check in the chat room and see if everybody is currently ready. Is everyone ready? How's the audio and the video? Please let me know. I made some improvements to the bandwidth here, so we should be able to do this without interruption. Do let me know if my audio or video cuts out at some point so I can stop and start my questions again. Very good. Let's do this. Marios asks, how can I practically participate in the Lightning Network? Do wallets support this? Should I download and run a node? Marios, actually, there's a number of ways you can participate in the Lightning Network that do not involve downloading and running a node. The best way, of course, is to download and run a node, but you may find that a bit difficult to configure. You have to run a full Bitcoin node, at least at the moment. In the future, we may see that work with a lightweight client called Neutrino. But for the moment, you have to run a full Bitcoin node and a Lightning node on top of it. And that's fairly technical, so you might find that difficult to do. There is another way that allows you to run a full node that's easier, and that's a desktop wallet called Zap. And the Zap wallet includes within it the functionality of a full node, so with a nice user interface. So you could try that. It will take up quite a few gigabytes on your hard drive. I think at last count, almost 200 plus gigabytes to sync a full node. If you don't have one synced already. But an easier way is to use a number of mobile wallets that already exist for Lightning. So for example, I have some running on my mobile at the moment, and both on Android and on iOS, although you'll find more on Android. So Blue Wallet and the Bitcoin Lightning Wallet are two wallets that currently support Lightning transactions. You could try those, as well as Eclair, E-C-L-A-I-R, which means lightning in French. Those three wallets work pretty well, and they can introduce you to the world of Lightning without having to run a full node for now. Marius asks again, what was the recent testing of Lightning payments? Sorry, let me try that one. Marius asks, was the recent testing of Lightning payments successful in terms of satisfying what Lightning was designed to serve? Marios, it's not really like there's specific testing. Since January of 2018, people have been running on a production network that has more than 6,000 nodes and almost $4 million in capacity on it, and are making thousands of payments every single day using Lightning. So it's not like there's a one-off test. This is now a production running network, and it is working. It is working spectacularly well. Payments are near instantaneous. That's one of the things that surprises people when they first try Lightning, is the fact that they press the button on their mobile wallet to send a payment, and in the time it takes to look away from the mobile and look at the screen of maybe a vendor's point of sale system or the website where they were making the payment, it's already gone through. It literally takes less than a second in many cases. So when it works spectacularly well. Sometimes payments fail because your node is not well connected enough or your wallet isn't set up properly, and these are learning steps. But for the most part, once you have it set up properly, it works very, very well. Marios asks, what is the lightning torch and how do people pass it to each other? So the Lightning Torch is just a game, and it's a game that's intended to test your nodes and wallets setup, so that you can find out if your node and wallet are well set up, and also participate in this test. It's really a simple idea. I send you some money over the Lightning Network, and instead of keeping it, what you do is you add a small amount. And I believe the last time it was 100,000 Satoshis. So you add a small amount to that payment, and then you find someone else to send it. You send it to them, and they add a small amount, and then they send it forward. So it keeps getting bigger and bigger. Everybody adds just a tiny amount, $1 or $2. And you have to trust who you send it to, because they could just keep it. But if you play this game honorably, you send it to the next person with a bit more money. And as it gradually grows, it gets a bit more difficult. And the reason it gets more difficult is because the bigger the payment, the more capacity you need in your node, the more capacity you need in the other nodes, the more channels need to be available for you to route, and the fewer routes are available for that kind of capacity. So it gets a bit more challenging. When it gets close to the payment limit, which is 4 million Satoshis, it gets very difficult to forward, because at that point, just a few nodes are capable of doing that in their current configuration. So your node has to be very well configured. I participated in this game. My node is very well connected, has plenty of capacity, well-balanced channels. I've been working on it for 9 months now. So certainly that one works very well. I had no problem passing the torch. You can try it as a game. Listen, if you give someone an invoice in order to receive the torch with the latest amount, and if they can send it to you, and they do, you then have to send it out. There's a chance that they can't send it to you because you don't have enough incoming capacity on your channels. So you'll learn something for sure about participating in this game. In fact, I think at the moment there are a couple of Lightning Torches going around at different values, so you can try it with a smaller attempt. All right, let me check in the chat room and see if everything's OK in terms of sound and video. All right. Ravi asks, on what scenarios do we have to use payment channels? Can you please explain in detail how the payment channels help the merchants? Ravi, payment channels are one component of the Lightning Network. So the Lightning Network is not payment channels. The Lightning Network is a network of routable payment channels where payment channels can be connected together in order to form a route that allows you to pay someone you do not have a payment channel to. And this is an important thing to understand. So if I want to pay someone on the Lightning Network, I don't have to have a payment channel to them. I have to have the payment channel to someone who has a payment channel to someone who has a payment channel to someone, et cetera, who has a payment channel to the merchant. So as long as your node is connected to 5 or 6 other nodes, and each one of those is connected to 5 or 6 other nodes, we take advantage of the network effect to create this ability to pay anyone on the network pretty much, very much reachable over a variety of routes without having to have direct payment channels to each other. That's the point of the Lightning Network. And what is the advantage of using that? The advantage is that you can have instantaneous settlement. So unlike the base blockchain where it takes 10 minutes to settle, because the Lightning Network funds are in a multi-sig that has already confirmed, the settlement of Lightning funds is instantaneous. It is confirmed instantly. And you can send very, very small payments for very, very small or no fee. So you can send Satoshis, not hundreds of thousands of Satoshis, but single Satoshis if you want. Now, there are certain scenarios where Some companies may set up, or individuals may set up payment channels directly to each other in order to manage situations where they have a lot of flows between themselves. So for example, exchanges could set up a network of payment channels between them, a mesh network of payment channels between them, in order to ensure that they can easily do transfers from exchange to exchange without incurring fees on the network, and instead be able to do it off-chain, as they say. So that's one other use of payment channels. And they can either do that in the context of the Lightning Network, or they could just set up direct payment channels without making them part of the Lightning Network. And so payment channels can also be used for this direct. Think of it a bit as a VPN. Like a VPN is an overlay network over TCP/IP, a payment channel is an overlay network over a blockchain. David asks, is there a limit from which, if you own below a certain amount of Bitcoin, you cannot transact, as it would not be economical for a miner to include these in a block? David, yes. This is called the dust limit. There is a mandatory dust limit of 546 Satoshis that below which your transaction will not be accepted on the network. So you can't make a payment less than 546 Satoshis. Separately to that, there is a practical limit whereby if you try to make a payment, the minimum fee that's required by all of the nodes on the network, which is 0.001 millibit, I believe, would be more than the amount you're trying to spend. So it would all get spent on fees, therefore your transaction wouldn't really make much sense. The second follow-up question, in the Lightning Network, is there such a limit, or is it possible to transact as low as 1 Satoshi? This is the exact point. It is possible to transact as low as 1 Satoshi. Better yet, on the Lightning Network, you can actually transact in millisatoshis, which are thousandths of a Satoshi, and you can transact down to as low as 1 millisatoshi, 1,000th of a Satoshi. Now, you cannot settle millisatoshis on the main blockchain as a cleared transaction. So you can't close that channel down to a balance of millisatoshis. So what the network does is it rounds up those amounts if you decide to close the channel. But in terms of Lightning payments, you can go all the way down to millisatoshis. So this is exactly one of the advantages of the Lightning Network. It breaks the barrier of microtransactions and allows you to push below the dust limit and make transactions that would otherwise be either economically unviable, unminable, or unpropagatable by the network because of other limitations. In Lightning, none of those limitations exist. You can go as low as a millisatoshi and do payments that are unimaginably small without any problems. Sifis asks, is there some form of information on a transaction that would show us which address initiated the promise of ownership, or how would we identify a payment channel? A payment channel itself is funded from an on-chain transaction that stores money in a 2-of-2 multisig, which will appear on the blockchain explorer as a pay-to-script hash address that belongs with a 3. You can't identify these as specifically being payment channels until they are closed. When they are closed, the script used to close them is easily identifiable as a payment channel or Lightning channel transaction, because the script is rather unique. But until it's spent, you can't see the script. As with any Bitcoin transaction, you only see the script or public key when it is spent. What you see is a 3 address, which is a pay-to-script hash, and you don't know what that is. It could be multisig, it could be SegWit, it could be Lightning channel. You don't know. You do know where the money came from, which addresses it came from, but that doesn't tell you that it's a channel. In fact, we don't want people to be able to identify what type of and easily be able to distinguish between SegWit, Lightning channels, payment channels, or multi-sig scripts, because that breaks privacy. If you can identify what kind of payment it is, you can start fingerprinting and doing statistical analysis on what kind of wallet it is, which allows you to cluster addresses together and identify common elements of ownership, which violates privacy. So the end goal for privacy in Bitcoin is, in fact, to make every transaction look like a simple payment to a public key. This is a technology called Taproot and Graftroot, which will hide it even more. But even now, until the channel is closed, you can't identify it as being a channel. Wenjo asks, can you please clarify why SegWit makes it easier for Lightning Network to run? Regarding Lightning Network, is it always the case that two parties need to reserve the same amount of funds for a payment channel? So let's break that into two parts. Why does SegWit make Lightning Network work? The simple answer is that the fundamental feature introduced by SegWit is the fix to transaction malleability. SegWit fixes transaction malleability. It makes it impossible for a third party to malleate a transaction, to produce a transaction with a different transaction ID but the same spendable amounts. The reason this is important is that in the case of Lightning Network, the parties are exchanging signed Bitcoin transactions called commitments, which are not broadcast to the network and which depend on transactions that are broadcast to the network and build upon each other, which means that you need to make sure that the transaction ID of the previous transaction cannot be changed, even though it hasn't been confirmed. This means that you cannot have transaction malleability. Transaction malleability makes Lightning Network much more difficult to implement, which is why we don't see Lightning implemented on Bitcoin forks that have not fixed transaction malleability. Transaction malleability was the primary reason for SegWit. And once you have transaction malleability fixed, then you can chain transactions together in a series of smart contracts and know that you can't break that chain and cause problems in the validation of those smart contracts through transaction malleability. Second question by Wenjo is it always the case that two parties need to reserve the same amount of funds for a payment channel? No, in fact, you can't even do that today. In order to do that, you would have to have the ability to create the channel funding transaction jointly through a multi-party transaction. That actually is a feature that is expected to be introduced in the Bolt specifications 1.1. coming towards the end of 2019. Today, when a payment channel is open, it is created by one party and signed by one party, and it is funded asymmetrically, meaning that there is balance only on the side of the payment channel belonging to the party that initiated the channel. So if I open a channel to someone else, all of the balance is on my side. The other party puts 0 on their side of the channel, which means that if we want to have capacity in the other end, they have to open a channel to me. Ideally, we would like a situation where we can both commit the same amount of funds. So I can say, I'll put half a Bitcoin on my end, you put half a Bitcoin on your end. Let's make a channel that is balanced on both ends. That's not how it works today. It's planned for the future, and it will make balancing channels easier. But for now, channels are one direction when they start. The capacity is all on one side. Once you make a few payments, the balance starts moving to the other side, so it's more balanced. But that also means that from a practical perspective, when you start a new node, all of the channels are funded on your side because you open them, and you have to wait or ask others to open channels back to you so that you can start doing so that you can start receiving payments. Meaning you cannot receive payments on Lightning until someone opens a channel to you with balance on their side. Sally asks, can you explain how transaction malleability can implement it? I thought that the transaction ID cannot be changed even in a very small way. That is a great question, Sally. So the transaction ID cannot be changed because it represents the hash of the transaction. That's the theory. Here's the practice. The transaction ID represents the hash of every part of the transaction except for the signatures. Now, in the past, the transaction ID included the signatures. And that's a problem. And the reason it's a problem is because the only part of the transaction that is not signed is the signature itself. And as a result, someone can change the signature. Anyone can change the signature in such a way that it affects the transaction ID. Essentially, I take a transaction, I produce a copy of it, an identical copy. Before it's confirmed, I make a copy of a transaction that I find on the blockchain being propagated in the mempool. And I look at that transaction, and I find the signature within it. And then I modify the signature. Now, since I don't have the private keys, I can't change the signature to sign something else. And I can't change the inputs or the outputs because those are signed, and I don't have the private keys to forge that signature. But what I can do is I can add something to the signature that doesn't change its function. Now, keep in mind, the signature is a number, right? So think of the signature as a number. Let's say the signature is the number 5. It's not, but let's use that as a simple arithmetic example. It's the number 5. Now, if I change that and how it's encoded in the transaction, and instead of 5, I write it so that it's 0.5. Now, 0.5 arithmetically is the same as 5. But when you write it inside a transaction serialized in binary, that extra 0 changes the data that goes into the transaction ID, which produces a different transaction ID. If you validate that signature arithmetically, 0.5 is the same as 5, so it doesn't really matter. You can think of it as doing arithmetic that doesn't change the outcome. You could rewrite the signature as 5 plus 1 minus 1. You can imagine various tricks. And these are arithmetic tricks. That's not exactly how they work. We're dealing with binary. We're dealing with a strictly serialized format. But the developers kept finding ways that you could modify a signature without changing its actual value. Modify how it was written, not what number it was. And therefore, when someone validates it, it validates the same way because the 5 was a valid signature for that transaction that the user signed. But because it's written differently, as 0.5 instead of 5, for example, when you calculate the transaction ID on this new copy of the transaction, it's a different transaction ID. So what you've produced is you've produced a second transaction that signs the same amounts to the same destination addresses, spends the same. Everything is the same except the transaction ID has changed. And that can cause a lot of problems, because if any other transactions refer to the original and you manage to get the copy confirmed, it breaks that chain, which affects things like Lightning and other things like that. So how was this fixed? Very simply, the signature was taken out of the transaction ID. So now the transaction ID is not calculated on the signatures. In a SegWit transaction, the place in the transaction where the signatures were is empty. Well, it has a specific fixed format, which is SegWit. And as a result, you can't modify it because the actual signature is outside. It's been segregated. And because it's outside, you can't modify it to modify the transaction ID. And if you try to modify it, you modify the part of the transaction that is signed, and therefore it invalidates the transaction. Very good. Checking in the chat room, drinking some water, taking a little break. Let's see. So the video was fixed. Turns out had some router problems and did a software update to the router. And now I'm actually getting some first world video and audio. It seems like we haven't had any problems. All right. Marcel asks, SegWit improves Bitcoin scalability, but is it enough for possible future mass adoption? Is scalability not one of the main issues of cryptocurrency, and how can it be solved? Marcel, SegWit improves scalability, but it is not enough for future mass adoption. And the reason for that is because we cannot solve scalability permanently. There is no such thing as a final solution in scalability. Scalability is solved differently at different scales. You have to have a scalability solution for each scale that you're trying to achieve, meaning that the problems we need to solve now for this scale of Bitcoin are different from the problems we need to solve for the next scale, and you never solve them completely. We see this on the internet, too. The problems you needed to solve in order to scale email were different from the problems you needed to solve to scale email with attachments and images, were different from the problems you needed to scale the internet to do voice, and different from the problems you need to scale for the internet to do 4K HD Ultra Netflix videos for everyone. At each level, when you solve one scaling problem, you open the door for new applications, which means you now have to solve a different scaling problem. And you can't, in the beginning, solve the problem for the end. There is no end. And also, if you prematurely optimize, if you try to solve scale problems for a scale that doesn't yet exist, you shift the problem somewhere else. In the case of cryptocurrencies, what you do is you damage decentralization today to solve a scaling problem you don't yet have. So for example, if we introduce 32 megabyte blocks today in order to solve the scalability problems of the future for transactions that don't exist yet, we end up with a blockchain that is mostly empty, that solves a scaling problem that doesn't exist yet, at the expense of making denial of service easier and shifting a lot of power to miners and centralized nodes by damaging decentralization. You don't want to solve scaling prematurely. So, can you solve it? Yes. SegWit is just the first step. There will be dozens and dozens of optimizations. The likely next step is Schnorr signatures, which introduces a 25 to 30% improvement in capacity by optimizing signatures and builds upon SegWit. Then we can look at signature aggregation, which is not going to be implemented in the first iteration of Schnorr, but can be implemented in future iterations. That can create a massive increase and optimization, because it allows you to have one signature per transaction instead of one signature per input, and potentially in the future even one signature per block for all of the transactions by aggregating them together. So scalability gets solved again and again and again and again with different optimizations. Some of these optimizations, in my opinion, will probably involve increasing the base block size, but you don't start with that, in my opinion. So is scalability one of the main issues of cryptocurrencies, and how can it be solved? It's not one of the main issues of cryptocurrencies. It depends on what you're trying to achieve. Effectively, right now, Bitcoin, for example, has enough capacity to handle all of the transactions that people need to send at reasonable fees without any problems. And it did as well when it wasn't being jammed by miners with fake transactions in order to drive fees up. So we did have some aberrations in fees, but these aberrations were mostly deliberate spamming of the network with fake transactions. I think in the future, we are going to see problems with fees again, and we are going to see capacity crunches again, which will force people to design more smart fee management, better transaction management within wallets, use technologies like replace by fee and child pays for parent, and various fee management techniques, so that the people who are willing to pay for transactions can signal that intent to miners, and you can have a fee market that is somewhat healthier than just shifting that cost to nodes. So that is one of the problems, but a lot of the problem of scalability, in my opinion, can be solved by building second-layer networks like Lightning Network, and even above and beyond third-layer networks beyond that. And the problems we need to solve in layer 1 are more on the privacy side, in my opinion, than on the scaling side. Sifis asks, why is the get block command needed? Why would one need to know in the future how many blocks there have been since the genesis? I mean, there might be a number of different reasons. One of the obvious ones is that you're building a block explorer, and you want to be able to show to the user when they ask for a specific block height. Who knows why they want it, but you need to be able to display that. Another answer might be that certain events happen based on block height, meaning that every 210,000 blocks we have a halving of the block reward. So that's one of the reasons you want to know the block height, because at precisely that moment in time, you change the reward by 50%. So the block subsidy is halved after every 210,000 blocks. So at block 630,000 in height, the difference between the reward at block 630,000 versus the block at 630,001 is 6.25 Bitcoin in block subsidy. And that's something you might want to know. And that continues. That continues out to 2140, the year 2140, with continuous halving. So that's one thing you might want to know. The other thing you might want to know is every 2016 blocks, you have a difficulty adjustment or retargeting, and that is also stored in the 2016 block. You will see the difficulty change between block 2015 and 2016 in the sequence. And again, that depends on block height. So you need to know that information. If you're looking for to make a chart of the difficulty across time, you need to take every 2016 block to see how it changed. Jan asks, how can I see the balance of any Bitcoin addresses that are not associated with my wallet and seed in Bitcoin Core? Great question. First of all, Jan, you need to understand that balance is not stored on the blockchain. Balance is calculated by adding up all of the different transactions so that you can measure that balance. Meaning that if you want to see the balance of an address, what your software is doing is it's counting all of the deposits and withdrawals, all of the inputs and outputs in the transaction, in order to see how many UTXO are stored with a script that corresponds to that address, and add up all of the value of that UTXO to tell you how much balance you have. Balance is an artificial concept that is created by the user interface, which means that in order for Bitcoin Core to calculate the balance of an address, it has to scan the entire UTXO set and find all of the UTXO. That's if you're running Bitcoin Core with a full index. If you're not running it with a full index, it can't do that. Now, it doesn't do that for every address. And the reason it doesn't do that for every address is because calculating the 26, 27 million addresses that exist, or however many exist nowadays, I don't even know, it might be 100 million addresses, would take an enormous amount of computation, and the average user does not care about 99.999999% of those. So therefore, because you're only interested in 1 in 10 million addresses, it doesn't do this. Instead, it will only calculate the stuff that's in your wallet. Now, how do you make it do it for an address that's not in your wallet, which is your original question? You add what is known as a watch address. So you basically say, here's an address. I don't have the private key in my wallet, but I want you to watch the balance. And then Bitcoin Core will go and calculate the balance. In order to do that, it will basically rescan the blockchain, and you need to send it a command to tell it to go back and rescan. So when you add a watch address, it will start watching from that moment into the future. If you wanted to also find transactions that existed before the moment you added it, you have to tell it to rescan. So it could go back. It will go back and look automatically. If the address has never been used before, you add it as a watched address. You don't need to do anything. If it has been used before and it already has a balance, then you need to tell Bitcoin Core to go rescan. That takes a while. You tell it from what block number to go scan. So for example, I recently needed to look at some addresses that I used back in 2017 for tax purposes. And so I needed to add those addresses as watch addresses on my node. And then I needed to tell it to rescan from the 31st of December 2016. And Bitcoin Core will convert that automatically into a block number that is from the previous day. And then it will start scanning from that block number up to today. It takes on average about 30 minutes to an hour to go back a year or two. And then it will produce a balance. And from that moment on, it will watch it. OK, checking back in the chat room. Let's see how it's going. All right, very good. No, I'm not going to tell you what alts to invest in. I don't give investment advice. I am a teacher, not an investment broker. Also, I do not recommend you invest in anything, especially if you have to ask someone else what to invest in. That means you don't understand what to invest in, which means you shouldn't be investing in these things. That's how you lose money to frauds. And also, I am interested in Ethereum, but not as an investment. So I'm going to slap down those two questions quickly. And Facebook coin. Very good. Next question comes from Jen. Many assume that some coins are lost forever. Nobody knows, and the keys could still exist. If Satoshi holds more than 2% of the maximum supply, what are the dangers of centralization of power in unknown hands? The same dangers that exist in any monetary or economic system due to the concentration of economic power in a few hands. And the concentration in Bitcoin, if Satoshi still has the keys and can use them and is still alive and still wants to use them, is quite extreme. It's more than you see in other economies. Of course, politically, I would consider that a very different scenario. In many economies where wealth has been acquired through various forms of exploitation, dictatorship, war, etc., versus the wealth that Satoshi potentially accumulated by both inventing and also investing in an early stage, very risky technology that nobody believed in. It's probably a different situation politically. But again, I can understand why people might be concerned about that. We have no way of knowing. And the market would incorporate that information fairly quickly. And the way we would know is if some of those coins started moving, we would probably see a response by the market. There's all kinds of conspiracy theories and discussions about who has those coins, whether they still exist, et cetera, or rather, whether the keys still exist. I'm not that interested in exploring those conspiracy theories. We will let the market find out for itself. And I believe that covers all of the questions we had. And I would be happy to do any follow-ups. And let's start with some questions that are relevant to SegWit. Stefano asks, as I understand it, SegWit transactions are seen as a transaction spendable by anyone for nodes that have not updated to SegWit. Is this a problem? It's a problem for those nodes because they may make assumptions about what is usable on the blockchain, but it's not a problem for the rest of the network, Stefano. You see, the thing is, you might be able to configure those nodes to try to spend these transactions because they're operating under the assumption that they're spendable, which is incorrect. The consensus rules in effect on the network today, and the consensus rules that are being enforced by every node and every miner, with few exceptions, are that those transactions are not spendable by anyone. Those transactions are spendable with a segregated witness signature. Now, what that means is that if you took your node and you used it to produce a transaction that attempts to spend these coins, you then transmit that transaction to anyone who is following the current rules of the network. Not only will they reject that transaction and refuse to propagate it to anyone else, they will also disconnect your node for lying. They will ban your node from the network. So everyone you send it to will go silent as they ban your node. And then you will be cut off from the network for trying to propagate lies. Because the idea that SegWit is a transaction spendable for anyone under the consensus rules on the network today and for the future is a lie. And that lie will not be propagated. You might as well assume that a node that pretends that Satoshi's mined coins from the first block are spendable by anyone and presents a fake signature from Satoshi. According to the rules of the network, there's no difference. One is invalid, the other is invalid. So there's no difference in terms of whether you choose to violate the rules by pretending that SegWit coins are spendable by anyone. They're not, according to the current rules. They require a witness. Or you pretend that Satoshi's original coins from the first block are spendable by you without a signature. They're not, because that violates the consensus rules. There's no such thing as half violating the consensus rules or kind of violating the consensus rules. You can configure your node to believe any rules it wants, including that Satoshi's coins are spendable without a signature, just as much as you can leave your nodes in an incorrect configuration to believe that SegWit transactions are spendable by anyone. They're not. If you try to propagate these lies on the network against the rules of consensus, either one of those lies, the network will ban you, and your transaction won't go anywhere. There were a lot of people saying that storing funds in SegWit carried additional risk. And that was proven to be false. It was proven to be false resoundingly by the fact that there are plenty of coins stored in SegWit. I can tell you that all of my cold storage savings are stored in SegWit multi-sig addresses. And anybody who wants to try and pretend those are spendable by anyone, be my guest, see how the network reacts. I'm quite comfortable putting my money where my mouth is. And I think that's all I need to say about that. Moving down. Lorenzo asks, where are UTXOs stored? Well, what are UTXOs? They are unspent transaction outputs. So they're in the blockchain, meaning that every transaction has transaction outputs. If you have a copy of the blockchain with the transactions in it, the transaction outputs are in that database. Now, they're not in an easy-to-find index. They're not in an easy-to-find database because they're just in the transactions. So unless you know the transaction ID, so you can look up a transaction and then find the outputs that transaction has, those outputs are sitting in the blockchain, but not in an easy-to-find way. Now, if you create a transaction index and you add a watch address, what your node software, for example, Bitcoin Core, will do is it will create a separate index for the database, your wallet index, that indexes all of the UTXO by script corresponding to addresses that you are watching, so that at any moment in time, it can look up by address and find specific UTXO. So in that case, you have the same database, but you have it indexed by UTXO entry, by script entry, script pub key as it's called, in order to be able to quickly look up all of the UTXO belonging to a specific address. But Bitcoin Core only does that for specific addresses that you tell it to watch. It does not build that index for everything. So the UTXOs are stored in the blockchain without being fully indexed. And they're only fully indexed when you tell Bitcoin Core to watch specific addresses. Now, if you are building a block explorer, let's say you're running the infrastructure for blockchain info or blockstream info or blockcipher or blocker.io, one of these block explorer websites that allow you to search and find the balances of addresses, well, they're building a fully indexed database of all UTXO and all addresses that they keep updated all the time. That takes a very big amount of disk space to store, and that's a much more complex database. And they do that because they need information, and they can't be calculating and rescanning that database. So they store a full UTXO set indexed by a number of different indices, so they can look these things up very, very quickly and present them on your screen. And that's custom software that they built to do this. Your wallet doesn't do this. So the UTXO is stored where it's needed, when it's needed, for the purposes that it's needed. Lewis asks, after 2140, when the Bitcoin block rewards go to zero and all coins have been issued, should we expect transaction fees to rise as an incentive to maintain and secure the network? Lewis, transaction fees will rise long before. This is a gradual change. With each halving, the profitability of miners changes, and the basis on which the difficulty, price, and profitability of mining equipment determines whether miners continue to mine or disconnect their equipment, thereby reducing the difficulty, thereby making more efficient miners more profitable, et cetera, et cetera, et cetera. This is a constant calculation. It happens every 2 weeks for every miner in the world. And based on that, that puts pressure on fees, and it creates both the fee market, the difficulty market, the mining market, and all of these markets that operate independently, but with some overlap and some price signaling between them. So fees will be considered as part of this profitability equation. They are considered as part of this profitability equation all the time. And they're considered today. You don't have to go to a zero block subsidy for miners to consider how much fees are contributing to their profitability. That's part of the equation today. And that equation constantly changes, at least every 2 weeks, but also affected by other things like the price of electricity, how efficient the mining operations are, their staffing costs, their ability to install new equipment and remove old equipment, et cetera, et cetera. So we will see transaction fees respond to market pressures, but so many things change between now and 2140, including the block subsidy, the capacity of the network, the efficiency of storing transactions, various new technologies, et cetera, and of course the price of Bitcoin. By the time we get to that point, the number of transactions supported on the network, the nature of the network, how much of it is happening in layer 1 and layer 2, all of these are unknowns. And the market will have long adapted to these new realities before. It's not like we just go blindly up to 2140 and then something dramatic happens. It's happening today, every single day, by every single miner in a free market economy. Price discovery, profitability calculations are happening every day. Nothing sudden happens. It's a bit like your 18th birthday, right? You know, you don't suddenly become an adult overnight and wake up the next morning and go, I'm an adult now. You know, maturity has been building all the way up to that point. It's a gradual process. The milestone, the checkpoint itself is relatively meaningless. John recommends some books. You can look at that in the chat room. I've also been interested in reading a number of books on finance. If you want to read, there's a lot of stuff out there. You can read Austrian economics. You can read other schools of monetary theory, like the Chicago School of Economics, Keynesian economics, etc., and compare for yourself. Another useful book is Debt, the First 5,000 Years, which is very interesting read. And it's important to understand how money works in order to understand why this new form of money does or does not work, or how it works and what impact it has. So there's a lot of economics that you can read. One of the interesting things about being involved in cryptocurrencies is that it forces you to have a crash course in fundamental economics concepts, both microeconomics, how markets work, which we see in things like the difficulty market or the mining market or even the exchanges, and macroeconomics, where you have to understand monetary theory and supply, demand of currency, inflation, deflation, stock and flow, and various concepts like that, in order to understand why Bitcoin operates the way it operates. James asks, is the ongoing reduction in energy prices a threat to Bitcoin price and Bitcoin mining ability? No, it's not. Again, these are dynamic markets. As the energy prices change, they don't change everywhere simultaneously. They don't change uniformly, and miners do not operate at the same level of efficiency. So the miners who gain an advantage due to lower energy prices will be able to make slightly more profit than the miners who don't, which is going to change the market slightly, gradually, and in different places at different times. This doesn't happen all at the same time. A reduction in energy prices probably simply shifts the mining industry to other forms of energy where there are opportunities to use cheaper energy. The cheapest form of energy we have on the planet is not a particular production method, but rather has to do with supply and demand. The cheapest form of energy is energy that is not being consumed, excess energy that is being produced but cannot be distributed or consumed. So the cheapest form of energy is surplus energy produced in locations where it can't easily be distributed. And we find that miners gravitate towards these sources of energy because that's where the price drives them. So effectively, Bitcoin mining in many cases acts as a mechanism for monetizing energy that would otherwise not be consumed, but is being produced anyway due to imbalances in production. For example, you have renewable energy that is being produced whether you need it or not by wind, by solar, by things like that, hydro, etc. And that energy, if it can be distributed, is wasted. It doesn't go anywhere. You still produce it. You can't turn off a solar panel. Well, you can't profitably anyway. So it produces whether you need it or not. That energy is by definition the cheapest because there is no demand and there is supply. So its price drops to zero. And if you don't have mining in the local area, price remains at zero. What mining does in that scenario is it creates a buyer where a buyer didn't exist, thereby increasing the price of that energy from zero to a fraction, and thereby investing in that energy company, effectively amortizing the cost, depreciating the cost of capital and infrastructure for that electricity company, which, if you think about it, is an investment in renewables. So reduction in energy prices doesn't damage Bitcoin price or Bitcoin mining profitability. In fact, what it does is it increases profitability for miners, but it also increases profitability for electricity companies, specifically in renewables that have this characteristic of oversupply, and therefore invests in renewable energy, which is great. Ashley asks, are you worried about the prospect of a Facebook or Telegram coin? No. Let me elaborate. I've been saying from very, very early days that eventually we will see corporate coins like Facebook coin or Telegram coin. We're also going to see digital currencies that are pegged or stable coins that are developed by large banks, JP Chase coin. And we're also going to eventually see central bank digital currencies such as a Fed coin or DigiDollar or something like that. And it could be any central bank in the world that does this. All of these have one thing in common. They are fiat. They are fundamentally centralized, censorable, bordered, controlled, vetted, closed systems that have all of the same characteristics of fiat. They're simply digital. And guess what? We already have digital fiat. All banks operate primarily with digital fiat. 92% of the money supply in the world is digital fiat that has no physical equivalent in cash. The only difference here is the implementation. Instead of being implemented as a SQL database, it's implemented as a blockchain database. Both are centralized, controlled by a central operator. Nothing changed here at all. Facebook will still not be able to transmit Facecoin across borders without complying with all of the banking regulations. Facebook will not be able to offer a coin that does not have strict KYC AML any more than PayPal can. Facebook will not be able to produce a coin that is censorship resistant, open, decentralized, neutral, borderless, or in any way similar to any cryptocurrency. They will recreate the world of digital dollars, PayPal, Venmo, etc. Sure, they'll be massively successful, and they will compete not against cryptocurrencies. They will compete against banks. And the reason they compete against banks is because the product they're offering does not differentiate from digital fiat that banks offer. So they can offer better user experience, better speed, better customer service, perhaps more brand recognition, better access for their digital fiat than Visa and JP Chase, PayPal, and Venmo. They should be very scared because they're going to get competition from Silicon Valley. None of this competes against crypto. And the reason it doesn't compete against crypto because crypto's differentiator is freedom, open, decentralized, neutral, borderless, censorship-resistant money for the entire world without discrimination, identification, censorship, and controls. None of those features can be offered by any of these coins. So if you believe that those features are needed in the world, and I can tell you they are, perhaps not by your average North American or Western European. They already have PayPal and Venmo and all of those things. Adding Facecoin isn't going to change anything to that. They are needed by people who live under currency controls and failing fiat systems, authoritarian governments, controlled centralized institutions, corrupt democracies, kleptocratic mafiosi banks, and all of these things. And guess what? That's 90% of the human population live under those conditions. And for them, Facecoin isn't a solution. It is simply another form of broken central currency. The open system is a solution to a very specific problem. And the problem is caused by centralization of control. And that problem cannot be solved by Facecoin and will never be solved by Facecoin. Facecoin will deplatform users. It will censor transactions. It will have to slow things down. It will require you to document who you're paying and why, for what reason, where you got it, why you got it. And if they don't like the answer, they don't like who paid you, they don't like who you paid, guess what? Your account will be frozen, just like PayPal does today. Nothing changes. In fact, Facebook is probably going to be more aggressive in freezing your account. It's going to be more aggressive in applying surveillance to all of your transactions and selling that surveillance to hundreds and hundreds of different intelligence agencies, corporate and commercial surveillance companies, totalitarian regimes, and things like that. Facebook will sell the financial transactions of dissidents to the dictators that are hunting them down and get people killed, because that's how fiat works. And that is a great place to finish this particular MOOC. Thank you all for watching. This has been the 5th session of the 11th semester of the Massive Open Online course for the University of Nicosia's master's degree in digital currencies. I'm Andreas Antonopoulos. I've been answering your questions. Don't forget, ask questions during the week in the forums so that you can both open a conversation with your fellow students, and I can collect the best questions so that we can answer them at the end of the week. I do answer some follow-up questions in the chat if I have time, but if you really want to ask a question, you can't wait until the chat. You have to post it in the forums in advance. Thank you so much. I'll see you next week. Take care. Study hard. Enjoy.